All right, boys. Happy Friday. Hope you guys are having an amazing Friday today. Today we are going to talk about put credit spreads. So I'm going to briefly go over what a put is and then explain the thinking behind a put credit spread. I'm only going to spend a little bit of time on what a put is and go more into the strategy. So you might need to look up what a put is and how they work before you watch this. So first off, let's explain what a put is. A put is, let's use Cinemark. A put is basically you betting that the stock is going to go down by a certain amount of time, right? So Cinemark is at 20 now. Let's say I think it's going to continue this momentum and it's going to hit 1750. I would go to trade, view options, February 19th, buy a put. And here I'm paying $95 for this bet, right? So what does this mean? Well, a put gives you the right to sell to someone 100 shares at 1750. So it's kind of different than a call. And this is what trips up a lot of people because I have the right to sell it at 1750, correct? Think about what I said. I'm selling or I'm paying for someone to give me the right to sell to them 100 stock at 1750. Well, how can I make a profit? Let's think about it. If Cinemark continues this downward trend and it goes down to, let's say, $15, someone gave me the right to sell to them the stock at 1750. So the stock at that point is worth $15, but I'm selling it for 1750. That difference would be my profit, right? $250 because the stock is actually worth 15, but I'm selling it for 1750 because we agreed about that. So my total profit would be 250, the difference between the stock and what I agreed to sell it minus $95 because I had to pay for that. So roughly, let's just say to keep numbers easy, $105. That's how puts work, right? Okay, so that is called a bearish sentiment or a bearish bet. I'm thinking that the stock is going to go down. A put credit spread is a bit more complicated. You're expecting the stock to either move up or stay the same price. So what I'm going to do here, even though I have one open already, is build one for you. So what you're going to do, because of the mechanics of a put credit spread, we're looking at the 1750 put and the $15 put. We're going to sell the one closer and then buy the one farther out. So think about why there's a price difference, right? There's a better chance that it's going to get to 1750. So this put is more expensive. Obviously, because the price is $20 right now, it's only $2.50 out of the money, right? $2.50 out of the money. And the $15 put is cheaper because it's $5 out of the money. So for the $15 the $15 put to hit, it has to move $5, right? So 1750 is more expensive. $15 is cheaper. What we're going to do is sell this one, sell the 1750, or actually I have it on buy. So sell the 1750 and then buy the 15. So what does this do? So you see the price difference here. One is 0.95 and one is 0.35. How does that help us? Well, that means that when we commit to this puts credit spread, we're going to get $60 back. So where's your risk here? Very easy. To gauge that, your max total risk or the money that you have to put up for this trade is the width of the strikes because of what I explained earlier. When you sell a put, you're giving someone the right to sell you the shares at 1750. And then when you buy a put, you're buying the right to sell someone the shares for $15. So what happens here, because you're doing a sell and a buy, you're agreeing to buy stock for 1750, and then you would have to sell it at $15. So your max loss would be $250. So you might want to run that back again. It's a little confusing. But the true break even, right, because you're putting up $250, but you're getting $60 back, it's $190. That's your true break even price. That's the max you can lose on this bet. Now, what happens if on February 19th, the stock is $18? Both of these contracts would expire worthless. You keep your $60. Nothing happens. You get your $250 back. Now, the opposite can happen. Let's say it takes a crazy dip. Tomorrow Cinemark is $10. Your shit is completely underwater. Basically the 1750 guy would exercise on you, right? And you'd agree to buy them for 1750, and then you would go back and sell them for $15. So you would lose $250 in the transaction. Okay. So the beautiful thing about put credit spreads, this is why a lot of people like them. There is a set risk, right? Like I can't lose more than 250. That's it. That's my maximum risk. And you already know what your percentage back is. So let's do the math real quick. If I'm getting back $60 on $250, 60 divided by 250, my return is 24%, right? And the market average is, I think, supposedly 8%. So it doesn't look like it's a lot of profit, but if you think about it long term, right? Let's say I'm churning these out every week. 24% is a great return. And you know, I could do, how many trades? 4 of these trades, and that would be like my max loss across the trades, right? Because if I do 4, I have $240, and then the next one after that, basically I'm free riding. So what if the put spread isn't going your way? Luckily, of course, I have one that isn't going my way. This is a 75-70 put credit spread for Cloudflare. It's at $75 right now, so it's staying above. The problem is it's for next week. So, you know, anything can happen. I only needed to move 40 cents and it's in the money, and I'm a little scared about that, right? So let's say I wanted to roll it out. I would go here. And basically, what you need to do is close this option. So you got to do the opposite of what you did to open the spread. So if I sold the 75 put, I need to buy it back. And then I need to sell the put that I bought, right? That closes it out. That cancels it out. And then what I'm going to do is go farther out, let's say the 19th. Because the farther out you go, the more expensive the contracts are, the higher the premium. So maybe I can choose lower strikes that are safer and make money back and exit out my scary position, right? So let's try doing a 70. We're going to sell a 70 and buy back a 65. Boom. And this is where you could actually see how much it's going to cost me. So if I was completely underwater, this would actually cost me 6 cents. So we don't want that. We want to try to roll it for a credit. So maybe let's try adjusting, go even farther out. Or maybe we could, let's do the farther out so you guys can see. So I was going to cancel that. So we were going to do 70, sell a 70, buy a 65. Boom. And now I get $2 back. Why do you want to get a credit? This ensures that you're not paying to stay in the position, right? Like, why would you want to do that? If you can roll it out and make money, you keep the original credit and then you get an additional $2. The only thing, of course, is that now instead of it expiring next week, we had to wait until February 26th. So it depends on how long you want to wait to be able to get out of the position, right? But let's say you just want to roll it out to the week after and you still want to stay aggressive. Well, you could do that too. So instead of going out far, let's go back to the 12th because that's what I was looking at originally, right? Let's just do a 72, 68 because that's going to keep our same width, $5 width. Total cost $40, so that's not going to work. So we'd probably have to do like a 73, something like that. See, so in my opinion, this is not even worth it because you're only moving it $2. It's not, you know, if it's gonna go down, it's gonna go down. It's not gonna move $2. There we go. So still, this is a cost. So it's just something you gotta try to balance out. You could either move the strikes down, or I mean, your goal is to make it a safer put spread. So you'd move the strikes down and go farther out. Or of course, if I was like, fuck it, I don't want to deal with this anymore, just do trade, close, and this is how much I'm paying to get out. And this also fucks people up. So if I sold something to somebody and then it gains value, I have to buy it back, right? So they paid me $165 for this spread, but right now it's worth $182. So if I want to close the position, I'm going to lose $17 on the position, right? And yeah, so another example, what if I open a position today and that should just, the stock skyrockets? Well, fuck, get the hell out of the position, right? And that's what happened to this one. I opened this one today for $90 each, and now it's at 68. Essentially, with put credit spreads, you kind of want to watch your return, right? I feel like 50% and up is good. Just get the hell out. Take your 50%, because what can happen is that this shit could evaporate literally overnight. Like one day you have the stock has a bad day, boom, everything is gone. So once this hits 50%, I will usually close it out. And if it's like 90%, I'm 100% closing it out. Because if I made $100 and that's like the max I can make, right? And the value is $90, why am I going to risk, like, why am I going to hold until expiration for the extra $10 when there is $500 at risk, right? So it's like I'm risking $500 to make $10. That doesn't make sense. Like, just close that shit out and get out. There's other put spreads like this one sold for 190 or 180, sorry. Something like this, I am going to be happy with the $150 back, right? Because it's very aggressive. First of all, because it's with GameStop. You never know. This thing, it tanked yesterday for 112. It was like $112 for a second there. So with something like this, I will actually put in an order, like I'm going to do that now, to close and leave it to just keep going until canceled. And what this does is it just sets the limit, right? So I'm going to put $20. Oh, I can't even do it because I just bought it today. But what does this do? This sets the order so that if the stock ends up skyrocketing, I don't have to scramble to put the order in. It's just there waiting. And then when it reaches $20, boom, it'll automatically close it out. I take my money, I move on, next trade. You do have to monitor your trades, especially like this one. This one is so close to being in the money. But there's no chance of it really assigning, right? Like there is a chance and they could assign at any time, but no one's going to do that because they lose the extrinsic value. Like people don't assign early. It's like not etiquette to do that. Like why would you want to lose that money that fast? You could just sell it off for higher than you the shares are worth, right? But it's important to watch it because you never know. Like I feel comfortable with this because I watch Cloudflare a lot, but for example, I had a Disney one expiring today. Lucky me, I got out yesterday. Unfortunately, it was $400, but it was a 170, 165. That shit does not look like it's gonna be safe today. So I would have lost 500 on that trade. So sometimes you gotta know, fuck it, close it out, just move on to the next thing. That's what I feel like a lot of people are not good at. Sometimes it's not good to hold. Sometimes you just gotta, take the $200 loss instead of the $500 loss, or take the $400 loss instead of the $1,000 loss. Because sometimes these stocks are just very unpredictable. And yeah, so I use put credit spreads on net a lot on super volatile stock. Like this one is beautiful. Why? Well, shit. Like, what's the chances of it actually getting to $7? It's even the pre-wave, the pre-gold rush. It was like 6 something already. So you want to be very aware of where the stock is at. Choose safe strikes. Like I wouldn't go to net and do like a $80 one or anything like that, right? You want to be able to know, all right, like it's not going to go below this price. And that's what charting is for, to be able to see how the stock has been behaving. So Cinemark, if you look at the month, it's been trending upwards, obviously, right? So if I did a put credit spread, it would be $17.50 because it just looks like it's never going to get back to that level. There seems to be a resistance or support level at $17.50. So that we know is a good, it's a good thing for us. I can go more into like the technicals of that, but that's how put credit spread works.